I want to welcome everybody to our Bay Area Housing Market Town Hall. Today, we are going to be talking a lot about the real estate impacts, strategies on Prop 19 and potential Biden tax plans. And we have our special guest and a good friend of mine. And he is also one of our leadership at NorCal CCIM, Tim Tikalsky, who is not only a CCIM, but he's also a CPA. So thank you so much, Tim, for joining us today.
You're welcome. Glad to be here.
We got before we start, let's summarize a little bit about what we do here. So our webinar is every second Tuesday of the month, and we have started since March 25th of 2020, pretty much a week after shelter in place happened. The main reason we started this is because because we moved into virtual world, we realized that there are a lot of people who just don't have a lot of real estate information, and we want to bridge that gap between consumers and local real estate industry so that you are educated and you have a good information to share, and so that we can help you and empower you during difficult times. Real estate industry at the time, we didn't know where it was heading, and then it kind of blew up afterwards. So a lot of people feel like they cannot catch up with what's going on. So this is where we are to help you keep caught up on the news, on the real estate legislations, tax legislations, so then you can make informed decisions when you come to a decision for real estate investment. So before we start, I want to share a book that I'm reading. Actually, I don't know if you guys can see since I have, you can see I have this book I just picked up not too long ago called Power Shift by Daymond John from Shark Tank. Me and my kids, we love to watch Shark Tank. And I really like him because he's very humble, and you could tell he started from a very rough beginnings, but he became who he is today. And this is, I think, his fourth or fifth book now. And when I was reading it, I can really resonate what he's saying. Now, one of the quote he was saying that it was me making a conscious decision to take control and putting myself back in a position where I could continue to get the most out of each and every day. And the main reason why I feel like it resonates so much with me, and as I had told a lot of you before, that I also wrote a book. Now, his book came out in 2020. I've been writing this book for 2 years now, and this is more about my life story. And my book is called Power to Change Lives. And I pretty much kind of said the same thing, but of course, Daymond John, he's saying in a much more beautiful way, I would say. And one of the main reasons I wrote this book is because I feel like in sharing my own story, I really want to inspire you or the audience. And mainly it was really my kids. I wrote this book for my kids to take control of their life. And even if you feel like you have no resources, but just know that there are always opportunities, no matter your gender, your skin color, your financial status. It is really up to you to find them and grab a hold of them. You can really have it all. It's not easy, but it is possible. And talked a little bit, not really about real estate particular. I say a lot of stuff about life in general. There are so many different obstacles from different perspectives, right? Not just about, how to make money, but really life has every obstacles you get through. It's a way to learn, and for your future to, it's a lesson for your future. So I talked about relationships. I talked about like difficult decisions that you have to make, and how to just jump through, this big obstacle and just make that decisions already. And then how, especially, Tim Tikalsky and I, we're part of CCIM, is a commercial real estate group. And it's known to be a male dominated industry, but I made a choice to stay. I made a choice to be part of the group, and they accepted me as who I am. And I became the president for the chapter last year, and now I'm serving the second year. So I do believe that, our lives is full of obstacles, full of, unknown situations, but there are always opportunities. And even though you have no resources, me coming to this country, not knowing anyone, I didn't have a family to stay with. Literally, I started from scratch, from the bottom, but I was able to find a way up. And I cannot be more happy now, where I feel like I found a home here. So I hope that this book can also inspire some of you, just like what Damon John is trying to do, to inspire some of the people to change their lives as well. I would like to go ahead and introduce back our speaker, Tim Tikalsky. As I mentioned, he is a CPA and a CCIM, and he has over 40 years of accounting experience. He's been speaking actually a lot at our NorCal CCIM chapter and teaching us how to use PPP loan, how to ask for forgiveness, and a lot of tax tips for our membership as well for our clients. So, Tim, welcome back.
Well, welcome everybody. Thank you, Helen, again for having me. As I was explaining to Helen earlier, she has violated my my propensity to procrastinate, because I'm actually scheduled to give this presentation in about 2 weeks, and I had been putting off preparing the slides. So when she asked if I'd like to speak on a couple of topics, I took it as an opportunity to prepare for that. So this is a work in progress. You'll notice that I think this was touted as being Biden's tax plan, and after talking to a lot of other professionals, they said, you know, it's not a plan, it's just amusing. And I thought, yeah, that was pretty amusing. Yeah, I think you're right. All we really have to go on here is Biden's really campaign rhetoric. So I'm not going to elevate this to a plan, but more talk about what we think is coming down the pike. We also are just rolling off of the implementation of the Proposition 19. So I know that many of my attorney friends were inundated with transfers trying to get done prior to the effective date, which was actually February 16th. So I quickly had to change this presentation to, now that you haven't, so you didn't do anything about Prop 19, now what do you do? So we're going to talk about that. And we're also going to talk about some changes, actually final regulations with respect to 1031 exchanges that I want to sneak in there, time permitted. I do want to give some acknowledgements to two of my very dear friends and very good professionals, Teresa Flugel, who is actually also a member of NorCal CCIM and a big supporter of that organization. She co-presented with me on this particular topic, as did Ryan Lockhart with McKenna Brink. Again, a very bright attorney specializing in property tax transfers as well as estate and gift planning. So that's a good segue into the big disclaimer here. So obviously, what I'm going to talk about is for informational purposes only. It's not intended to provide legal, tax, or accounting advice, and you should seek your own tax, legal, and accounting advice. And if you need a referral, happy to give one. Hey. So what we're going to talk about is, first of all, the implementation of Prop 19 and what now can we do under post Prop 19 transfers. We're going to discuss a technique that's actually not a new technique. It was one that we've been using to avoid Prop 13 reassessments already. So this is one that now has come even more important with the exclusion of the exemptions, as we'll go over, or elimination of the exemptions. I do want to briefly talk about 1031 update, specifically the regulations that were finalized as a result of the change in the law from allowing like-kind exchanges for personal property and real property to restricting only to real property. So Treasury decided that it was probably a good time then to finalize regulations regarding what exactly is real property. So we'll talk about that. And then lastly, as I said, we'll discuss some of Biden's tax musings. So, so with respect to Prop 19, there was some good news and there was some bad news. I think the good news was really what got people to vote for this. Had they really delved into the bad news, I think that this might not have passed. It was kind of a footnote. But with respect to the good news, so everybody's aware that Prop 13 restricts the assessor's ability to reassess the property at its true fair market value. There is a locked-in fixed base value that can only be increased 1% every year. So Prop 19 does not change that. But what it does do is allow for individuals who own property used as their principal residence to sell their principal residence and buy either in the county or outside of the county. There were many counties that allowed intra-county transfers, but it wasn't statewide. So what Prop 19 did was make it mandatory statewide. So that is the good news. Now you don't get a complete pass if you sell your principal residence and buy an extremely more expensive residence. The assessor is not going to allow you to carry over your base from the previous residence. So you must buy a replacement residence of equal or lesser value in order to retain your Prop 13 base. I give a quick example on the slide here. The taxpayer had a $500,000 tax base with a $1 million fair market value. They decide to downsize and replace the residence. I shouldn't say downsize, decided to move and actually upgraded to a $1.2 million home. In that situation, they will get a carryover of $500,000 on their original base, but to the extent that the replacement property exceeded the fair market value of the relinquished property, the assessor is allowed to assess the excess $200,000. So on the new property, the property tax base would be $700,000. So the bad news of Prop 19 was the elimination of what we called the Prop 58 exclusions. These are the parent-child exclusions. Under old law, parents were allowed to transfer their principal residence, either by sale or by gift, to their children, and there was an unlimited carryover of that Prop 13 base. So there was no restriction for the child to have to live in it. It simply was the fact that if a parent transferred to a child, that was exempt. Now, however, so you still have the ability under Prop 19 to transfer your principal residence to a child. However, the child must live in it as their principal residence. So that immediately becomes problematic if I have more than one child.
I was just about to ask you that
Yeah.
question, because most parents would transfer to multiple children, and what happens if only one child lives in it and the other few don't? So
that would not allow you to take advantage of this exclusion unless both of the children lived in the personal residence. So much of the planning that was done prior to February 16th was actually to go ahead and transfer the principal residence to their children, either jointly or maybe in trust, and then actually rent the residence back from the children or the trust in order to maintain that Prop 13 base. It's no secret that the biggest asset that taxpayers usually have, especially in California, is their residence. So this came, I think, as a big surprise to people that there would be a reassessment on the death of both spouses at this point. So we still have the ability between spouses. Okay, that's not a problem. But this would be, that second death where, dad has been gone and now mom is gone. We've transferred the residence. unless the child lives in it. Sorry. Secondly, what Prop 19 did was eliminated the second exclusion, which allowed not only a principal residence to be transferred, but other real property, a vacation home, a second home, a rental, a commercial property. Now, it wasn't as generous as allowing for all of the property tax base to carry over, but there was what was called the exemption amount, and that exemption amount was up to $2 million of the assessed value, not the fair market value. So if an owner had a Prop 13 base of $2 million, but the fair market value of the property was $5 million, that still qualified. However, that's just historical because we no longer get to do that. So there is no exemption for the transfer of real property unless it's a principal residence owned, lived in by the child.
Got it.
Okay.
So in this case, maybe you're going to talk about it later. What are the step-up cost basis?
Yeah, we'll talk about that. That's on death.
Okay.
Yeah, that and that may or may not have any bearing on the assessor's ability to assess the tax. Just because you receive a stepped-up basis with respect to property transferred on death doesn't mean that the assessor is allowed to assess that stepped-up basis. Example would be husband and wife. If husband dies, they jointly own the property or is community property. Under current law, there would be a stepped-up basis on both halves of that property, but that is not an assessable event for the county assessor.
Got it.
So when does the assessor get to assess? In other words, saying it another way, when does the assessor get to step away from the fixed base percentage, fixed base amount for Prop 13 and get to now reestablish that Prop 13 base at the fair market value? Well, it results in a change of ownership. A change of ownership that, again, does not qualify for the now sole surviving exclusion, which is the transfer of principal residence. So it's really any transfer of real property. It can be an interest, 100% interest in the property, or it could be a fractional interest in the property. That piece that is transferred is subject to reassessment at the fair market value, again, unless the exception is made. There is an exception, however, to the transfer of property to an entity. So as I said before, if we transfer a real property interest to a child, or anyone, could be a relative, or an unrelated third party. The point is the transfer of the property is reassessed without an exception. There is an exception, however, to the transfer of property to a legal entity. And just stepping back, why would they allow this? Well, what the legislators decided is that the mere change in form of owning real property should not trigger an assessment. If everybody that owned the property prior to the transfer now owns a proportionate interest in the property, in the entity that owns the property that's transferred, then there isn't a change in ownership, is there?
Right.
I mean, we simply just took, husband and wife took property, put it into a, this slide says,
like an LLC.
Yeah, well, you could put it into an LLC, you could put it into a corporation. I would never, ever recommend putting real property in a corporation. That is a topic for another discussion.
Yes.
But let's just consider the transfer of the property to a limited liability corporation, which can be taxed as either a corporation or a partnership. So default partnership, that transfer not subject to reassessment. And here's the trick. So the trick is, once that property is held by the LLC, and let's just say it's mom and dad owning 50% each in that LLC, the ownership of the entity itself can be transferred to anyone, and there won't be a reassessment of the underlying asset that's owned by the LLC, i.e. the real property, as long as that transfer does not constitute more than a 50% change in ownership of the entity. So let me give you an example. Mom and dad form an LLC, and after the transfer, they own 100% of the LLC. Again, as I said, that is exempt from property tax reassessment. Now the parents gift away or sell the ownership of the LLC itself, the interest itself. And as long as that transfer is not more than 50%, or saying in another way, no one person after the transfer owns more than 50% of the LLC, then there is not a reassessment.
Mm-hmm.
Well, that's great. So what we've done now is we've got up to the 50% mark. What do we do after that? And by the way, once we get to the 50% mark, that next 1% transfer will trigger reassessment, not just on the 1%, but on the entire property owned within the LLC. Okay, so very critical. It used to be, well, and again, now, I mean, it used to be, now we still do this plan where we say, once we get to the 50% point, we can utilize that rule that I previously said, which is change in entity, right? So now we're at a point where we can liquidate the LLC and distribute its sole asset. This was a single purpose entity, and do that pro rata. So let's just say we got mom and dad went from 100% to 50%. The kids now own 50%. And now we terminate the LLC and distribute an undivided interest to the existing members. That is not a reassessable event.
Right.
That is exempt. So now we went from the real estate being owned by the entity to now the real estate being owned as tenancy in common between parents and the children. Now, of course, any transfer individually, because now we're outside of an entity, aren't we?
Right.
So if mom and dad continued to give away their 50% interest, that, you know, if even if it was a 1% interest, that would get reassessed. The 1%. Of course, not everything is going to get reassessed. We're no longer in an entity, but it kind of stops our estate planning at that point. We can't transfer any more to the children without triggering a reassessment on what's being transferred, can we? Well, yeah, we can.
You know, I mean,
because now,
I don't mean to break up this train of thoughts, but I kept thinking how many times I've seen people do quit claim deed from parents to children and then go all over the places when they don't consult with a CPA like yourself.
Well, yeah, and again, depending on the property type and the assessed value, they may not have, prior to Prop 19, they may not have triggered anything. Again, if it was transferred principal residence to the children, okay, fine, there was an exemption. And if it was a $2 million assessed value, that would have been okay too if it was to kids. But yes, you're absolutely right. You know, it was interesting. We were doing a lot of planning for clients around the expiration date or the effective date of Prop 19, and it was amazing what we saw as far as ownership. Right? Oh yeah, no, I own that property 100%. Well, then we pull up the deeds and we look. No, you gave 20% to your kid, 3 years ago, and you didn't do anything about that. So yeah, it was eye-opening to see. You're absolutely right. I mean, people just kind of willy-nilly do this without consulting a professional, to their ultimate detriment. But anyway, so to continue the point, so we went from owning the property in a 50-50 owned entity to now owning it 50-50 TIC, and we are stuck with now what do? We can't give away the property or we'll trigger an assessment. Well, yeah, we can, because again, we can use that rule that I mentioned. Well, if all we do is change the form of business into an entity, there is no reassessment as long as it's pro rata. So it's like we just cycled all over again, and now we form a new LLC. Now, be very careful, okay? And there is a warning on this slide that says beware of the step transaction doctrine. So if an assessor sees that property was distributed out of an LLC one day, and then the second day there was reformed another entity, and there's a form that's filed to say, okay, we want exemption for this because it's identical owners, that is likely to get rejected.
Yep.
So what we have to do in tax law a lot of times is we have to put daylight in the transaction. We have to age the transaction. So if you were going to pursue this strategy, you would want to liquidate the first LLC, hold the property as tenancy in common for a period of time, recommended at least maybe a year, maybe 2, and then reform the LLC. And now you're off and running with mom and dad gifting their interest in the newly formed LLC. And again, as long as no one child in that situation owns 50% of the entity after the transfer, well, if I've got 2 kids, at the end of the day, mom and dad have transferred 100% of the property to the 2 kids, 50-50, no reassessment. So not only have they avoided property tax reassessment, but they've gotten the asset out of their estate such that it won't be subject to estate tax, which we'll cover, time permitting in a minute here. So, and again, as the slide says, the kids are free to do what they want. I mean, they can continue on after mom and dad's death. They could continue to own the property in the LLC. Typically what happens, they usually probably liquidate the LLC, take their undivided interests, and they do with it what they want. 1031 exchange, sell it, cash it out.
And this is why it's so important for especially elderly parents, or if you're adult children, to get this started as soon as possible. Don't wait until, don't wait too much. Let's start planning on this, because this is not something that just go, oh, I'm going to get it done within a year. It's probably a few years of planning in order to achieve that.
Well, yeah, and that's a good point. And the other thing too, and this came to light under the Prop 19 frenzy, was you shouldn't just simply focus on property taxes and avoiding property taxes. This needs to be part of an overall estate plan. What does your estate plan look like? And does it make sense for you to be transferring property to the kids now during life? It may not. Helen, as you alluded to earlier, we do have the ability today to, with property passing from a decedent's estate, we'll get a stepped up basis to the fair market value. And that's even if the estate was not subject to an estate tax. In other words, if the estate was less than the unified credit amount, which today is 11,700,000, subject to change, by the way, we'll talk about that. So that would have been maybe foolhardy, because now the kids, received the property back. Again, they got the property tax base, yay, but they also don't have the stepped up basis. So if they were to sell that property after mom's death, they're going to pay tax on the gain that was based on the tax basis they inherited or was gifted to them from mom.
True.
So that is a consideration and a balancing act that we need to do. I just put this slide in here because I want to remind everybody that strategy works not only for gifts, but you can do installment sale of the property. You could do, again, a sale leaseback, like we said, with the principal residence. You could even do a like-kind exchange among related parties. There are some specific rules, but again, you can, avail yourself of these other techniques. As a reminder, if you do transfer property, especially in one of these transactions like a sale leaseback, you do got to do what you said you did. Okay, so you've got to change the title. If there was a sale, you got to pay the transfer taxes. You're gonna, if you carry back a note from the sale, you have to impose an interest rate that's at least the applicable federal rate. Mom and dad who sold their principal residence to their kids' trust and are now leasing it back, they're going to lease it back at fair rent. I mean, you're going to have to, abide by that. And then not to mention the fact that you might now want to carry renter's insurance, okay? Because you are now a renter. So there are some other costs associated with doing these. You need to weigh the benefits with those costs.
I'm so glad you mentioned this because we do have clients ask about even let's say installment sales, if we do it within the family. So should I just charge no interest rate? I mean, I'm okay with not charging interest rate. You cannot do that. You have to make sure that it makes sense. Or, oh, can I not charge rent, or the rent is ridiculous low? You cannot do that. It has to make sense. It's not something, I mean, it's
because if you transfer property, say the principal residence, and mom and dad continue to live in it until they die, the IRS has every right to say, you never have a transfer in the first place. They had what's known in the business as a life estate. They retained a life estate in the business such that they didn't pay rent when they transferred it. So they continued to enjoy the benefits without having to pay for it. That is not a gift. That is not a transfer. They continue to enjoy the benefits. So yeah, absolutely. Okay. Oh, I forgot to set my timer.
You're good. 4:53.
All right.
I'll watch any questions if there is.
I'll give myself maybe another 15 minutes here.
Yep.
Okay. So just real quickly, again, as I mentioned, because the 1031 exchange rules back in, I guess it was 2017 when the law changed. You used to be able to exchange both real and personal property as long as either one was used in a trade or business or held for investment. Okay, so I could trade my BMW for a Mercedes, and that's by the way, that's why trade-ins, you weren't taxed on the trade-in if the dealer gave you a value for your car, which was probably way low than what it was worth. But anyway, the point is, the reason they were able to do that was 1031 exchange. You no longer can do that. Okay, a trade-in of personal property will be taxed as if you had sold the property and used the proceeds to buy the replacement property, if it's personal property. So because of this change in the law, again, IRS felt the need to issue final regulations. They had temporary regulations sitting out there for a long time, and didn't get off their duff to finalize them. They decided they finally had to do that. So that's what these regs primarily do, is define what is real property for purposes of a 1031 exchange. Now, some of these rules, don't confuse these with what we just talked about, okay? As far as what is assessable as real property by the county assessor necessarily, or what is depreciable as either real property or tangible personal property under the tax laws. Those are different, okay? This is primarily for 1031 exchange. Do I have real property that I'm trading for real property used in a trade or business or held for investment? And not surprising, because we've used this for years, in spite of the temporary regs, state law controls. So if in California, if I own a piece of property, or excuse me, if I'm leasing a piece of property that has a lease of more than 30 years, well, pursuant to California state law, that's equivalent to a fee simple, okay? So it is common for people and still allowed to exchange long-term leases, land leases, for real property. It is deemed to be that. Now that's in California, okay? There probably are other states that do not treat long-term leases as real property. So that's just one example. But you might say, well, why does state law have to dictate that? You know, it could be that there's a contingent interest in real estate. Is that really deemed to be a real property? I've got a client who has an option to purchase real property. I get this question a lot. So if I have an option to purchase real property and I want to exchange that for real property, I can do that, right? Because I have the right to buy this property. Well, no, that's a contract right, okay? The option to buy real property is not like kind with respect to real property. Now, if you did want to do that, you would exercise the option, buy the real property, age the transaction, okay? Because again, you know, did you have real property that you used in a trade or business or held for investment? Well, if you exercise an option, immediately turn around and bought another piece of property, you're not going to meet the held for requirement. So anyway, I digress. But anyway, that's the reason that we need these rules, is to define real property. The other reason we need to define real property is when you buy a building, you buy the structural components and the non-structural components, don't you?
Yeah.
I mean, there are lots of times furniture fixtures embedded in that. Sometimes there's special purpose things like HVAC or you know, reinforced concrete, specialized wiring, those things that could get shorter tax lives for depreciation purposes and therefore be treated as personal property, are under state law definition still considered to be real property for purposes of 1031 exchange. So, so again, that's critical if a client has done a cost segregation study, tried to maximize the depreciation deductions, has designated a lot of the what looks like structural components as tangible personal property to get the benefits of the depreciation. Are they going to run afoul of the 1031 exchange rules? And the answer is no. Yet, as long as that property is deemed to be real property under state law. So again, that's what these slides pretty much go through. You know, the general rule is if it's nailed down, dug into, or permanently affixed to land, it is likely real estate. Okay. So that's what these tests have a tendency to do. The final one is what's kind of a safe harbor test, which says that if I buy a pool of assets, structural components, and a bunch of tangible personal property, I buy a hotel, you know, and I buy all the beds and all the furniture, fixtures, equipment, all that. Am I going to blow the exchange because I transferred personal property? And the answer is, as long as the value of that personal property does not exceed 15%, again, pursuant to the these final regulations, then no, you're not going to blow the exchange. Now, you will have taxable boot gain on the sale of that personal property. This doesn't exclude you from that, but at least you won't blow up the whole transaction. Now, in real practice, this doesn't happen because what we're doing, we never encourage our clients to sign a contract for the purchase of real property and tangible personal property. Those are typically done in two separate purchase transactions. Yeah. So you wouldn't be in a situation here where you would have to prove 15%, right, or less if you wrote up a separate contract for the transfer of the
This is what I was thinking when you were talking about this, is that, sometimes we do have clients like, okay, we pay this price, but we would like these personal property come with it. And we have to be very careful how we draft that contract for our clients, because again, if we are specifically saying like, okay, this amount is towards the personal property, then you better talk to their CPA and make sure that that is the right way to draft a contract. Otherwise, that can be.
Absolutely. I mean, it occurs with the purchase of personal property. It occurs with the purchase of a business.
Yeah.
So a lot of times we'll have to untangle a purchase contract that it has a business embedded in it.
And from the real estate or realtor point of view for us, and because we do have so many clients who need to do 1031 exchange, and then sometimes we could see that not everyone understand how 1031 exchange works. You have to make sure you work with somebody who understand the rules of 1031 exchange. Talk to a CPA, talk to a 1031 exchange intermediary, and they will walk you through what is qualified and what is not. But because if you're trying to do a 1031 exchange on something that's not qualified, at the end, you're going to be paying quite a bit of tax.
Well, you could blow up the whole transaction.
Yeah.
Absolutely, very easily. So just in the time remaining, so here we go again, one of kind of a prelude into Biden's musings. So they are talking about eliminating 1031 exchange again, and for real property as well. So there's a lot of smart people out there that have done a lot of studies that said if you eliminate 1031 exchange, you will absolutely devastate the real estate market. And it's not surprising. I mean, people will hold on to property, if they got to pay a huge amount of tax. And so it will stall or curtail transactions. So those arguments will be made again, but please, if you have any interest at all, reach out to your legislature. There are organizations that actually Teresa Flugel's CDEC, their president, I think, sits on one of the boards of one of these advocacy groups. So if you any interest in preserving 1031 exchange, please write your congressman, and this link is here on the slides. All right, so in the time remaining, what can we expect coming forward? Again, there is nothing written in stone at this point. These are simply campaign rhetoric, but it is rhetoric based on studies that have been done for prior administrations. And so we always tend to go back to those and say, okay, well, what was on the radar scope when, what was the previous presidents were? Obama, I can remember his name, see how quickly we forget. So a lot of these were in the radar at that point. So let's just go over them real quickly, and I want to leave time for questions. So as far as the corporate tax rate, one of the big things that Trump had done was reduce the corporate tax rate down from 35% to 21%. So of course, Biden wants to undo that. He wants to raise that back to 28%. They also repealed the alternative minimum tax with respect to corporations. They didn't repeal it with respect to individuals, surprisingly enough. They're talking about reinstituting that, but only for very, very wealthy corporations, over 100 million in global income. Actually, in response to the cut in the corporate rates, the individual answer to that was allowing the 20% deduction for qualified business income. And you're probably familiar with that one. That's called the QBI deduction. If you have a active trader business, you get a 20% deduction off the top. If it's an active trader business, I was going to say material participate, doesn't matter. Active trader business, 20%. And during the last negotiations of this TCJA, real estate businesses were excluded. Rental real property is kind of this hybrid thing where Congress doesn't know what to do with it, I think. A lot of people, they don't know, okay, well, you're renting, you're leasing property. So that kind of looks like passive income to me, right?
Right.
And therefore, we don't want to give you a break on passive income. That'd be like giving you a break on dividends and interest and that type of thing. But no. I mean, we have to maintain the property. We have to, find tenants. We have to kick tenants out. This is a business. I mean, if you talk to anybody that does this for a living, it's a business. And the only extreme case would be maybe if you were fortunate enough to be a pure triple net lease, where all you did was go to the mailbox and get a check. Okay, I can see that. But again, Congress is very conflicted. They don't know. They don't understand. I don't think they understand the real estate market.
And especially if,
But the lobbyists were able to get this 20% deduction in for real estate trades or businesses. It's likely going to be eliminated. In fact, the whole QBI deduction is likely to be thrown out for incomes over $400,000. So anyway, that's one. The other one is the individual rate. So again, the TCJA lowered that rate to a top bracket from 39.6 to 37%. Biden wants to put it back to 39.6. We've already had a big haircut in all of our itemized deductions. So as we all learn, our state tax deduction is limited to 10%, limited to $10,000. They eliminated the deductibility of miscellaneous itemized deductions. Those were deductions that were in excess of 2% of AGI. So really all we've got left is home mortgage, which by the way is limited. Okay. Yeah. For mortgages of $750,000, unless you were fortunate to get grandfathered in.
They're keeping that.
So they're keeping that. They're keeping gifts to charities and casualty losses. But what they're talking about doing is going back to what's called the PEAS limitation, which is for individuals that reach a certain income threshold, they're going to reduce your benefits for itemized deductions. So they'll start to haircut, your deductibility, itemized deductions, to a point where it cannot exceed more than 28% of your taxable income or benefit. Of course, the big, out of time, but the big elephant in the room is what we talked about, the 11.7. It's actually, this slide says 11.58. That was in 2020 and 2021. Everybody has the ability to give away property up to 11.7 million. That would be 23.4 million per couple. That exemption amount increases every year with inflation and is due to be severely curtailed in 2026. In fact, the law was to expire in 2026 as part of this TCJA and go back to $5 million adjusted for inflation. Biden wants to change that. So not only is he likely to accelerate the expiration of this large exemption, but he wants to reduce the exemption down to 3.5 million.
That's huge.
And he wants to increase the marginal tax rate for estate tax. So again, the death tax. So the amounts that are over this exemption amount will be taxed at a 45% marginal tax rate. Currently, the rate is 40%. And of course, to rub salt in the wound, he wants to eliminate the stepped up basis on death for inherited property.
So it seems like everything is pretty much, expect your tax is going to go up pretty much.
Well, so you just pointed it out, Helen. We had a $1.9 trillion bailout in December. We had a $2 trillion bailout prior to that. We're approaching $4 trillion. We got to pay for that. And where's the last time we had a bailout? And don't think 2007. Can you think of it? I wasn't born yet. You certainly weren't born yet. Most of the people on this audience probably weren't born yet.
So it wasn't the 2008, the bailout.
No.
You're talking about even before that.
I'm talking about that.
Wow.
It was the 29 crash. And it was the passage of the Social Security Act. I'm serious. So that was a bailout for retirees that had lost all of their savings in the 29 crash. And we are to this day still paying for that. We are still paying for that. And this is history repeating itself.
Yeah.
Because our kids and our kids' kids and our kids' kids' kids are going to be paying for this going forward. But anyway.
Yeah, I think I
editorialize.
That's why I was saying that just that stimulus plan is gonna. That's like a whole another topic about it, because that has definitely going to stimulate our economy short term, but what will happen long term? And I mean, this is a biggest debate for a lot of different countries. Some countries are very adamant about like keeping the tax rate low, and but then there are countries that keeping the tax rate really high, and also a debate about like what is the best way to increase revenue. Is it to keep the tax rate low so that we get more people doing transactions, the GDP grow more, so then you can have
we could have a whole discussion on
exactly.
that, Helen. But just keep in mind that the budget for Social Security surpasses our military budget. It is bigger than our military budget.
Mm-hmm.
Okay, and this is going to be the same thing going forward. So yeah, there's only two ways we can pay for it, right? One, raise taxes, or two, print more money.
Yep.
What happens if we print more money?
Inflation.
Inflation, which is a tax. It is a tax. So we're anyway.
Yep. Well, there is one question by Celine Simon. She's actually part of our HAYLEN group as well. She helps a lot of commercial clients regarding the scenario where parents transfer their personal residence to their children as a gift while continuing to live there till death. How much rent do the parents need to pay in order to have the transfer considered a gift, and for how long?
Fair market value.
Mm-hmm. Yeah, just
what
like
is the fair market value of that property in your geographic area?
Yeah, you can give
that's what it takes.
Like the fair market value, the lower end of fair market value, but you cannot be way too low. That doesn't make sense. Great. Well, thank you. Yeah, thank you so much, Tim. This is like really helpful, and especially the Prop 19. I think this is.
I wanted to get to, if I have time, just for one more slide. We talked about the 1031 exchange going away. I think the big one that's on the horizon here is a change in the capital gains rates. So right now we do enjoy capital gains at a low marginal tax rate, anywhere from 0, depending on your income level, to as high as 23.8 if you add in the Medicare tax. So Biden is threatening or talking about taxing capital gains at the ordinary income rates if your taxable income for that year exceeds $1 million. And of course, the question is, well, does that count the big capital gain that I got? Yeah, you bet your bippy it probably does. Okay, we don't have the details yet, but it's likely that if you have a large transaction over $1 million, you're going to pay ordinary income on that gain, likely over the $1 million. So I guess the caution here is that if you're considering selling property and it makes economic sense, you might want to do that sooner rather than later, all right? Because we have the law today with a lower capital gain rate. Can they make the law retroactive back to the beginning of this year? Well, technically, constitutionally, they can. They can. It's not practical. And in my 40 years being in business, they've never done that. But they are not precluded from doing that. So, and there's no bills pending. But I guess my point is, if you're contemplating a sale of property and either want to take a capital gain or do a 1031 exchange, you better get on the bandwagon quick. Okay.
I think, yeah, it sounds like we are making sure everybody has to get on it and think more about it and really talk to the CPA about it. Obviously these tax plans, they are not it hasn't passed yet, but this is what they're talking about, and it is we all have to be part of this solutions and voice our opinion, especially with 1031 exchange. I know a lot of different real estate organizations are really big on trying to voice their opposition towards this. So hopefully we're
Write
not
your congressman.
1031 exchange. Because I can totally see that it's going to affect a lot of our clients.
Right.
But
okay.
Well, thank you again, Tim. This has
Thank you for
been
the opportunity.
really useful and also very informative. And I hope that you all learned a lot from this. And if you guys do have any questions, feel free to let us know and email us. We will send you the recording of this webinar, and you can go back and review. I know that was a lot of information, so for sure it's going to be posted on YouTube channel. And I hope I'll see you in April. Bye.
Subscribe, people.